Yeah. Two. Yeah. Aye. I'm jacking the beat, you calling the cops, the yapping is cheap, I call you the ops, the rapping is hating, it's all cause of pop. You get a leak for the ball, get a drop. Feel like I'm wrong when I double it back, cause I'm making it harder to catch that. But I covered the ticket, I call you to visit, you tipping and hit up the cash app. Baby girl, been around for it, yeah. In the old days, I was stuck in old ways, never really trying to flip the old page. Young man tripping at an old age, thinking I was flicking, had a low wage, led the broad days, then a slow praise, thinking it'd be different, it would gon' change, then it really didn't, it's a cold game, yeah. Ay, all I really wanted was the money in the pocket, got over money, but the money ain't the topic, like Bill Doe and the money gotta stop it, kid need food and the whip need juice, I'ma get these views when
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refi to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner looking old, so fresco clean. You see that thing, guys? Take a picture for your mom and them guys, and welcome to another edition of Real Estate Live, man. It's just going to be me today. Cliff is out of town taking care of his business for us today. It's all good. You got me looking all so fresco clean. You see that thing, baby. Take that damn picture. But guys, today, guys, we're going to dive into a topic that I've been DM'd a lot on Instagram about this topic, guys. And it walks right into our current market analysis. But before we get into that thing, guys, do me a favor. Click on that subscribe button and that like button, guys, so we can get the algorithm going and get some more eyeballs, guys, because what we're going to share today, guys, is going to be very good for everybody. So now, let's dive into this thing. All right, guys. Today's current market analysis, guys. We're going to talk about something that was really pressing upon me because I was getting a lot of messages from people concerning this topic of the U.S. credit rating, the U.S. government credit rating downgraded from AAA to AA plus, and that news came early on in the week. But most of the discussion was either around President Biden or President Trump and somewhat so of their legal woes, guys, so to speak. But this kind of skirted under the radar. And so people began asking me, hey, LaDale, man, what do you think about this credit rating going down from AAA down to AA plus? And I said, good question. Let me dive into it and see what's going on. So, guys, let's go ahead and see what's going on. We're going to bring up the actual company themselves that actually makes the decision on if a government's going to be downgraded or upgraded or not. All right. Here it is. Let's dive into this. He was on CNBC, right? And let's see exactly what he says on the reasoning why they decided to downgrade the U.S. government from AAA to AA plus. Let's get into this.
News of the morning, though. Fitch, as you know, downgrading U.S. long-term credit to AA plus from AAA follows their rating watch negative call back in May and is the second downgrade ever by a major agency after S&P back in 2011. Joining us first this morning on CNBC, the man behind that call, Fitch Ratings co-head of the America's Sovereigns, Richard Francis. Richard, great to have you with us. Thanks for this.
So this is the man behind the decision of downgrading the U.S. government credit rating. Let's see what he says.
Time.
All right, thank you.
I would love to know sort of some color on the timing and the thinking behind the call now. As some have pointed out, some of your quantitative models have actually been on the mend the last 6 months or so.
Listen.
Yeah, I mean, honestly, this is a steady deterioration that we've seen in some of the key metrics for the United States for a number of years. Debt to GDP in 2007, general government debt was less than 60%, and now it's 113%. So there's been
he said the debt was back in the day was 60%. Now it's 130%. Damn. It jumped from 60 to 130%. Good God. Let's keep listening.
There's been a clear deterioration. Furthermore, we're expecting fiscal deficits to rise over the next 3 years, and we expect.
So now he's saying that he expects for deficits, and again, deficit means deficient. The core word, the root word for deficit is deficient, which means not enough. So when you hear the word deficit spending, it's talking about not enough spending. So in other words, there's not enough income coming in to really engulf the spending. So you're spending more than is coming in. And so what he's saying that there's going to be more of deficit spending. That's not a good sign. Let's keep going.
Debt to continue to rise over the next 3 years. And furthermore, because of the higher interest rates and the higher stock of debt, we're now seeing the interest burden rise pretty fast, actually.
So now he's talking about interest rates rising fast. And he's talking about in the next 3 years, guys. Not the next 10, 3 years. He's saying that the interest rates have risen too fast, right? And he sees that it's going to continue to rise because of what? The increase in deficit spending. It's not hard, guys. You cannot manufacture cash flow. Cash flow has to come organically. When you are exchanging a good and services for currency, you cannot manufacture cash flow. That's what printing does. That's deficit spending. Let's keep going.
In the case of the United States. So the underlying numbers are, especially on the fiscal and debt side, are quite negative.
When it comes to the argument about governance and responsibility, government responsibility, why not? I know you referenced January 6th as part of this call. Why not do this a couple of years ago?
Yeah, I mean, I think, again, like the debt and the fiscal burden, we've seen a pretty steady deterioration in governance over the last couple of decades. And I think that you can highlight a few key elements. One would be the January 6th, but secondly, I think more importantly for us is the constant brinkmanship surrounding the debt ceiling, the debt.
Hold on, wait a minute. Hold on. My man's in them said January the 6th. I'm calling cap on that. Because if January 6th was so catastrophic, why didn't you wait? Why'd you wait for 2 years afterwards if it was so catastrophic? So now I'm hearing a little political talk there. Doc, we don't need political talk, man. We need facts and figures. That's all we need. Stop all this political talk. January 6th, my ass. Come on, are you serious right now? This is trash. Come on, man. Keep it fiscal. Fiscal, okay?
Debt ceiling debate. The fact that the government, both sides, Republicans and Democrats, haven't been able to come up with kind of meaningful long-term solutions to deal with growing fiscal issues, especially around.
So now he's pointing toward the debt ceiling. I can agree with that because of the fact that this debt ceiling deal was only for, I think, 1 or 2 years. So there's no real solution to the debt ceiling. I mean, if there's a solution, all they're going to do is they're just going to raise it again. They can't stop printing, guys. They cannot stop printing. If they print, you are SOL. They can't stop printing. That's why it's called deficit spending. Not enough income coming in to support the debt. Just keep going, guys.
Around entitlement programs, Social Security and Medicare. I mean, I think these are the type of things that highlight the importance of governments and also the inability of the government and both parties to come up with some kind of solution.
So I know you talked a bit about this morning about what would it take to get an upgrade back? Some sort of sustainable sign that governance is on the mend. Can you talk about what that might look like and whether or not the deal that we got this summer is any hint toward that directionally?
Yeah, I think there's a couple of things that we probably want to see. One would be some kind of solution, long-term fiscal solution, tackling the entitlement programs, for example. Willingness to somehow look at the revenue side of the picture and/or the spending side of the picture, and actually bring down the deficits enough to at least stabilize the debt to GDP, which I mentioned is already like 3 times the level of the AAA median. Wow. So it's much higher than the AAA median and much higher than any other AAA country, actually. And it's even higher than the AA category. So first tackling, these type of issues. And, honestly, the debt ceiling itself,
Look at that prediction, guys. Rising deficit fears, general government debt to GDP ratio, 118.4%. That's ridiculous. I mean, we're severely upside down. You owe more than what your economy is producing. That's craziness. That's really catastrophic, guys. That's just like you actually having a real estate property, guys. And with the real estate property, you actually owe more than what the value of the property is. It means you upside down. That is what's going on when it comes to our economy. They are printing more. We owe more on the debt than what our gross domestic product or GDP, the value of our economy, is producing. That is not good news at all.
Is it, kind of suspending it or getting rid of it somehow? That would actually help as well, because the idea that the United States reaches the next state and all of a sudden cannot pay its bills, again, we don't think that's consistent with the AAA either.
Wow. So guys, that was the company Finch that actually handles raising of the upgrading or downgrading of credit ratings for countries, guys, and what he listed, guys, when it comes to deficit spending, when it comes to GDP versus debt ratio. There, he got a little political talking on January 6th. That was trash. There, because if January 6th was so important, why did you wait 24 months for you to actually put that in there? And that's exactly what the commentator actually asked him. That was a great question by the CNBC commentator. And this deficit spending problem, guys, they cannot stop printing. They can't. Because when you're printing, you're manufacturing cash flow. All right, you're manufacturing. So now you're seeing what's actually happening right now at CNBC. That's more of a macro level, the whole nation. Now let's look at it, how it's affecting Main Street, people like that. Okay, let's see what's going on there. All right, guys. So let's go to another news article here, which talk about this as well. Let's see how this is actually affecting the everyday person. Let's see.
And time to talk your money. America's credit rating taking a real hit right now. The U.S. debt rate has been downgraded for only the second time in history.
Wow.
And Local 10's Hat Silvella is joining us. He's in Hollywood right now with what that means for your wallet.
So he's in Hollywood.
Christy, certainly a big deal in the financial world, in the world of Wall Street. But what does it really mean here on Main Street? The financial world is watching closely. Fitch Ratings downgraded the U.S. debt rating from a perfect AAA to a AA+.
Wow.
The effects already being felt.
Listen.
The three major indexes were down by mid-morning. Global stocks also fell Wednesday.
I am monitoring the markets with the big news today.
Which is why we were at his office. This is Chad Neesmith, a portfolio analyst at Tobias Financial Advisors.
A credit rating downgrade hasn't happened since 2011.
In fact, it's the second time in history it happens. The credit rating agency says they did it because of a steady deterioration in standards of governance over the last 20 years. That simply means Washington cannot get its act together. Just this May, both parties bickered over raising the debt limit to keep the government from defaulting on its financial obligations.
Part of this has to do with just overall the polarization that we've seen in politics over the long term.
Today, the Treasury Secretary says she strongly disagrees with the downgrade, pointing to positives in the economy.
Its flawed assessment is based on outdated data and fails to reflect improvements across a range of indicators.
Experts say a downgrade.
Now, watch this, guys. She actually said, come back to me real quickly, guys. I'll go back to the thing. She just said outdated data. Listen to the verbiage, guys. What does she mean by outdated data? It's very simple, guys. When it comes to the inflation rate, the Bureau of Labor and Statistics, that's a federal agency, guys, they actually govern what that is. Well, what the government has done as of this year is they changed the metrics of measurement from every 24 months to every 12 months. So now that they are finagling with the numbers now, meaning that it's outdated. Does that make some sense, guys? That whenever, of course, they changed the definition of inflation now to where it was 2 consecutive quarters. Now they actually changed it to be a different measurement now. That's trash. So again, in her stance, that's outdated. So Fitch is saying, no, we're going by fiscal definitions, things of that nature, which is actual definitions, the meaning behind words, where you have the government changing metrics, changing definitions. I'm not surprised at all that they actually downgraded their credit rating. I'm not surprised at all, guys. And also, they can't stop printing, guys. They cannot. Let's keep going. Let's go back to it.
Downgrade could make it harder for the government to borrow money. So what about the short term, and what does this mean for the average American?
Good question.
The main effect would be possible higher taxes in the future. Today, really not much in effect.
As a certified
Well, hold on. My man's in them said possible higher taxes. Why is that? Man, come back to your partner, man. My man just said possible higher taxes. Why? You are dealing with deficit spending. Again, I have to define what deficit spending is. The root word of deficit is deficient, which means not enough. Okay? There's more money going out than revenue coming in. Hence, deficit spending. The only way you can actually curtail that, guys, is really in two ways, and one way they can't do. The one way is become more conservative with the printing of money, which means stop printing so much money, right? Or number two, they got to tax you. That's why he said that taxes will most likely go up because they're not going to stop printing, guys. Let's keep it a band. Let's keep 100. Let's go back to it. Let's go back to what he's talking about. Here we go.
certified financial planner and analyst, Neesmith tells us if you have a financial plan, stick to it and don't make any drastic changes based on the credit downgrade.
If the market's down, it's a good day to buy most of the time.
All right. So now you're talking about buying assets, specifically on the stock market below wholesale. That's great. If you can buy an asset, whether it be real estate, or stocks below wholesale, or to where you can make a profit, do it. Do it. I would just say I would move my money buying something tangible and hard cash. I always say insure, leverage, and protect. Insure your money first, leverage your property, and then protect it. Right? Put it behind something tangible, something hard assets, things of that nature. All right, guys? It's the same thing that the banks do. Same thing that they actually do, guys. So, man, where is the economy going? Well, guys, this is what I think. That's what I think of where it's going, guys. Number one, the government will not stop printing, right? So get that out your head. Number two, taxes will continue to go up. Yes, it will. Why? Because they have to make up that arbitrage there of two. Whenever you have, again, deficit spending is more money is going out than revenue coming in. So that the only way they can bring that in, the government only makes money realistically, guys, on taxes. That's it. Taxes, right? And some tariffs too, depending on how it's structured as well also. But the major source of revenue is taxes. Okay? Understand that. All right? So taxes will go up because they will not stop printing at all. So what I think is going, guys, we're already in recession. Let's stop the cap. Number two, the Fed will raise the rates again, right? Because they have to, right? Because the counterpart, which is the Congress and the executive branch, will not stop printing. And that's no matter if there's a Republican or Democrat in the White House or controlling the power of the purse was the Congress. There's no matter if you have a Republican or Democrat in there, they can't stop printing. They cannot. That's why I always say it doesn't matter what the Fed chairman does. If Congress does not stop printing money, and as well as the executive branch, it's a wrap. So for you, I would just copy what the banks do or copy what Wall Street does. Put your money behind something tangible. Simple, guys. Ain't nothing hard to do. Simple. All right, guys. Stop waiting on these politicians to solve your problems. It will not happen. That's why you're the investor. It's your money. Stop being passive and begin to be more actionary, more intensive with your investment strategy. Okay? Does that make some sense, guys? So that's why I think it's going, guys. Now, let's dive into this luxury apartment investing, guys, real quickly. Man, in the major areas, right? In the major areas, major towns, New York, Philadelphia. I'm naming a couple of places as well. You have a lot of vacant office spaces. And there's a ton in New York, a ton in those areas. Well, with those vacant office spaces, they're trying to look at turn those into profit centers. Now, how do they do that? They're trying to look at a plan of transforming those office spaces into luxury apartments. So there's been kind of a boom there. All right. So let's see what's going on with that whole place as well, guys. And then we get up out of this thing. All right, guys. Let's see what's going on. You're going to be very surprised at what's been the major hindrance to this actually coming to fruition. You're going to see right at the beginning. Okay. Here we go.
The U.S. is in a rental housing crisis.
So we pay $3,060 per month. If I'm really honest, I don't think it's a very good value for money.
Home builders believe the sector is already in a recession, and experts are...
They're correct. They're correct. No matter what people are telling you about the recession, we're already in it. Stop playing the cap. Let's be honest.
calling out laws that make building expensive.
40% of the cost of multifamily development is in regulation.
She is spot on. So 40% of the cost that we actually take in, I'm a developer by trade. I develop a new construction properties, whole subdivisions. Okay, guys, the majority of that cost is in regulation. Okay, now mine is a lot more is cheaper than 40% because I'm dealing with single family residences. But when it comes to multifamily developers, it's a different beast. That's a commercial space. I'm very aware what that is as well, guys. When you're building in cities, because what you have, guys, real fast. Whenever you're developing a project, okay, what's happening is you have a single family residence and you have a commercial multifamily, right, guys? And if it's annexed, or annexed mean if it's governed, who's governing it by the county, a county normally has more lenient type of permitting process, right? When you go to a city, it can be very intensive, that permitting process. And what's happening is the lion's share that costs, 40% of that cost on the multifamily side is in regulation, which regulation means the permitting process. Okay, guys? It's a huge bureaucracy when it comes to commercial development, multifamily. It is like pulling teeth. All right, guys? So it's important for those that are developing apartment complexes, whether it be new construction, multifamily, or renovation, right? You're going to encounter a lot of a regulation permitting process. All right, here we go. Let's go back to what's going on here.
We have to do something about that if we're going to build more housing.
That's correct.
Developers have a really hard job, and they regularly work magic.
In major cities like Washington, D.C., developers are working with limited space.
Most parts of this country have exclusionary zoning. The only thing you can build there is single-family homes, often on pretty large lots.
That's correct.
But in the parts of town where big buildings are allowed,
you see a lot of cranes going up. Those cranes are going to build high-rise luxury apartments.
And in fact, this year we're going to see some of the largest number of apartments delivered in the luxury sector than in history, literally.
Why are there so many new luxury apartments?
Listen.
And what could the government do to get more affordable housing onto the market?
I can tell you one thing, guys. The government, get out of the way. Again, I'm not saying that there should be no regulation. Yes, it will. Yes, it should. But get the extracurricular regulations out of the way. Okay?
When it comes to city real estate, the biggest luxury is location.
If you can just walk from your apartment into a metro station and head on about your day, that's pretty great.
Here's a look inside of one new development in the city.
Right now, we are in the Ballpark District of Washington, D.C.,
yes.
One of the emerging neighborhoods that is downtown adjacent. And this neighborhood has gone through a tremendous transformation over the last 20 years as part of an overall plan to create an extraordinary place. This building was completed in 2020. And this is the Kelvin Apartments, which is 312 apartments over about 60,000 square feet of retail.
Yeah.
Adjacent to our sister building, which is the NV condo, which is 127 condos.
It's good.
This development is currently valued at roughly $230 million.
Yes.
Transit-oriented development creates the best outcomes overall because of the proximity to jobs, the proximity to educational opportunities, but is also the most difficult.
Yes,
You're creating not only deep foundations for underground parking, you are often building over metro lines and transit lines.
Yes.
You're also taking care of the neighborhood in terms of its aesthetic.
Yes.
living in this lifestyle does cost a premium for the renter.
It does.
2-bedroom apartments in this building can rent for over $3,000.
Wow.
Single bedrooms can rent for over $2,000.
Wow. Guys, in Texas, that will actually get you a full-fledged house with a front yard and backyard and 2-car garage. Some even 3-car garages. In Texas. This is in Washington, D.C. It's crazy, isn't it?
Perhaps more surprising.
And you're looking at square footage around like anywhere from 2,500 to 4,000 square feet, depending on the area in Texas.
Those prices are technically affordable for 40% of the households in Washington, D.C.
Okay.
And this pattern where the top 40% of earners can afford housing while others struggle to find affordable housing can be found in cities across the U.S.
So you often see new housing branded as luxury, in part because it's new.
Yes.
I will say in my personal experience, I've seen pretty high quality, affordable, subsidized housing that could compete with any luxury house.
And the thing about it is, I'm liking this, guys. This is an actual a U.S. Official in HUD, guys. He's even saying that it's overregulated. Man, I'm liking this, man. Okay.
I've also seen pretty old, tired housing still branded as luxury that, wasn't the greatest housing out there.
Here's another building that was completed in 2009.
Luxury, it's definitely not, but maybe a little bit up standards, like a little bit.
The building has about 300 units and is worth over $129 million.
Appearances-wise, and from the outside, this flat looks amazing. It is amazing, and there's so much light and the location and everything. But then when you actually live here, there's so many tiny things. In total, it's 30 maintenance requests in a year and 5 months. So it's quite a bit.
Days before this interview, a malfunctioning dishwasher flooded parts of Carolyn's apartment. Building management brought in industrial fans to dry the space.
Wow.
It's 75 decibels. I measured it.
So guys, concerning that real quick, guys, excuse me. If you're wanting to get into apartment complex, a reconstruction or building a new construction, what actually happens is, what you saw at the end, there's a huge maintenance thing that you have to look at, guys. It's real simple. You got to make sure that you know what you're doing. Make sure you understand the whole permitting process. Make sure you actually have good relationships with the local. We're talking about county and city officials, because you're going to have to talk with them and shake hands with them and also kind of smooth them a little bit to make sure everything's good to go, guys. But also make sure you understand that at completion, make sure you have a good maintenance team in place. No matter if it's luxury, you hear what he said. Luxury just means new. That's all that really means. But that could be some amenities there as well. Also, just make sure you understand what's going on, guys. So, but guys, man, thank you so much for your time. That's all I have for today, guys. Real simple. Again, I'll tell you this all the time, guys. And if you want to get into apartment complex investing, joint venture investing is the key. It is paramount, because you bring that credit profile, that balance sheet, and the experience that you have a good, successful project, guys. So again, joint venture investing is going to be the most powerful investment strategy moving forward. But guys, thank you so much for your time, guys. And again, the free real estate masterclass is coming soon. We'll keep you posted on what's going on, guys. But guys, thank you so much for your time. God bless you. You always know how I end it every time that we get something done. I always say, before you leave, and while you can, you see that thing, guys. Take that picture for your mom and them, guys, and holla at your partner, guys. See you next week. Peace.
God give thanks. Whoa. Bless God, give thanks. Bless God, give thanks. Whoa. Bless God, give thanks. Whoa. Big God, big grace. Whoa.